Mistry is with us, co-founder, Buoyant Capital. Jigar, good to have you back on the program. I mean, I remember your views last couple of times. You've been cautious. You've been cautious for a while. And I think it's working out well. If you're sitting on cash, as Deepan has been, what's the view? Deepan was earlier telling us that, I mean, no reason to be excessively bearish now. You've got to start to have an open mind and you know, maybe at least scout, if not press the button. But just your thoughts on what you're seeing.
Hi, Prashant. Yes, I think, see, what's transpiring is that if you take a 5 or a 10-year rolling return on any index of your choice or any stock with a long enough trading history, the free cash flow and the share prices or the index prices have always aligned with a sort of a percentage or two here or there. Those two have always followed in complete sync. This is on a rolling return basis. However, when I looked at, say, about a month and a half back when we last spoke, the sort of 3-year CAGR on the large cap was a percentage or a 2 percentage points difference. But small caps earnings growth was something like 14% and the share price growth was 26% CAGR. So there was an embedded 12% CAGR overvaluation that was built into small caps in general. This needs to unwind because if over a 5 or a 10-year rolling return, the two numbers always coincide, then essentially you must be able to argue that the earnings growth will be way above trajectory, and failing which the share prices have to correct. Today, or at least at that point in time, and even today, we were not in a position to argue that the earnings growth will be materially higher than what the trend numbers have been, and therefore it stands to reason that the share prices needed to correct. Now, there are 2 or 3 ways in which it could play out. One, the stock share prices go flat for 2 years and the earnings grows 10% each, and then that corrects the anomaly. Or sort of the index corrects 10% and the earnings rise 10% over a year, and that corrects the anomaly. Or worst case, today stock prices fall 20% and the earnings don't really change, and that corrects the anomaly. So I think we would somewhere be in the sort of second or the third trajectory, where given that retail has been driving a lot of this embedded value creation, it would be reasonably swift. We had moved predominantly into large caps over the last few months, and we will be looking at opportunities over the next few months on where we can increase exposure into a lot of these otherwise interesting companies.
Jigar, hi, afternoon. You've not been a big proponent or fan of taking cash calls. Instead, your approach has been adjust the beta of your portfolio in order to ride out all the cycles, the down cycle that we've been in. So tell us how your portfolio is constructed right now and incremental adjustments that you're making. Take us through the view there.
Right, Reema. So, if I give you a statistic to start, if you were in the markets since the early 2000s, you would have been exposed to something like 6,000 trading days, and your returns would have been around 17 times or thereabouts. Of those 6,000 trading days, 10 days, 0.2% of the days have accounted for 60% of the returns. And we have all heard of power laws, 80-20, or if you are in venture capital, then maybe 99-1%. But we haven't really seen a power law where 0.6% of the days, 0.2% of the days, account for 60% of your returns. 25 days, which is 0.4% of the days, account for 84% of your returns. Obviously, there can't be a strategy to identify these days, right? These days, and you can just get positioned accordingly. In absence of which, creating very large cash calls is counterproductive, because if you miss out on a few of those days, then you end up generating sort of extremely low returns. And therefore, what we end up following is getting into small and mid caps when the markets get very, very sort of pessimistic. So peak of COVID, when everybody else was buying IT, pharma, FMCG, that's where our small and mid cap positioning was almost 65% of the portfolio. By September 21, we had started reducing that. By the time Russia-Ukraine happened, we were even Stevens. Similarly, in May 23, we were again 65% of small and mid caps. And today, as of end of January, we have 52% large caps and a much smaller exposure into smaller caps. Within sectors, I think we have debated this in the past. If I look at the same earnings versus the share price dislocation, then financials, healthcare, discretionary, and real estate sort of stand out. Materials as well, sorry. Real estate is one sector that we don't understand all that well, but a large part of our sort of portfolio is positioned therein.
Okay, all right. Hi, Jigar. Good afternoon. And I think you know the sector I'm going to ask you about. What do you do with the metals pack? Trump's tariff seems to have ruffled feathers today, at least. And the stocks are very, very nervous. But we've seen in the past that sometimes these stocks recover. And I think for the ferrous industry, the bigger point is, will there be some protection that will come in? And could these tariffs now actually make their case even stronger? How do you approach the space?
Right, Nigel. So I think in an era where the value of the dollar is being propped up by measures that are driven by the executive, then sort of as a commodity, metals sort of start taking the brunt as it is. In the event where you put up artificial barriers to trade, and in this scenario, I don't even think they were, like for example, Mexico and Canada, this was supposed to come into effect on 4th, and suddenly on 3rd, they completely changed everything. In this case, I think they're sort of taking a very broad brush and trying to apply it to a broad sector of commodities, and therefore, in an environment where dollar is appreciating, commodities as it is don't do well, and then you add to this the tariff troubles, it exacerbates the situation. So my sense is that, okay, if all of this were to play out, then you will see a situation where these companies don't do well. But as you mentioned, these are counterbalancing effects. So, if you do something, I'll do something else. And eventually all of us will end up generating a higher inflation for both of our countries. Hopefully when the leaders meet, I think it's later in this week, I think these situations could get threshed out in a better fashion. But otherwise, it's a lose-lose for everybody. And India's trade surplus last year was something like $32 billion overall. FDI until last year was positive, although net FDI now is getting into a little negative trajectory. So a broad brush sort of thing with India, I don't think really sort of matters as much as sort of with a few other countries who are carrying one-sided deficits with the US matter. But I think this should work out over the next few weeks as we see it.
Okay. All right, Jigar, thank you very much for that. Shorter conversation today, but thank you for the perspective. Just a quick check before we head